Hi guys, so in this video I'm going to go over how to understand the nature of the stock you're interested in trading and how to sensibly determine a stop loss and target price, okay? Now to do this we're going to be looking at the historical returns and average volatility of the stock, and we'll use the Volatility Analysis tool that we've got available in the premium content section of this website. So just under the Volatility Analysis tab you can go ahead and download this into Excel. We'll go ahead and open that up. Now let's say that we're considering buying shares in C.H. Robinson, which is a Fortune 500 logistics company. The information displayed here is going to tell us how this stock's historically performed over the last 20 years. So this tool breaks down analysis into quarterly, monthly, weekly and daily analysis. And the first thing we're going to look at is the mean, okay? So this is quite simply an average of the daily return across the last 20 years just about. So we're looking at just shy of 5,000 data points, and what it is it's just a simple average of the return, and the return is calculated by taking price when stock opens versus the price when the stock closes, and that calculation that we've got here in column I is simply averaged across all of our data points. And as you can see here, the average is 0.09. So that's the midpoint essentially of, or the average of all of these returns accumulated. And what we can do with that information is, when we are doing statistical analysis, okay, we're looking at the standard deviation. And for those of you not familiar about standard deviation, I highly recommend reading into it and just being aware of what it is. It's a very useful way for us to assess the probability of price moving, and by how much. Okay, so standard deviation is basically a measure of the dispersion, or how spread out the data is from the mean. And I suppose to best explain this, I will demonstrate a normal distribution curve. So here's one I googled earlier. This is a normal distribution curve, okay, and this 0 point here is your mean. Now one standard deviation, either above the mean or below the mean, captures about 65% of all the data points, okay, that we've looked at, and two standard deviations capture 95% of all data. Then if you look across to 3, that captures typically more than 99% of all the data from that set that you're analysing, right? Now that's in a perfect world. This is a theoretical demonstration, okay? If we actually look at this stock, we can see here that the frequency of one standard deviation is actually 78.5%. Alright, so basically price has either moved 2% up or just shy of 2% down on a single standard deviation day, and that's occurred 78% of the time over those 20 years that we've been looking at, okay? This one standard deviation is simply the standard deviation plus the mean for the upper standard deviation, and the lower is quite simply the mean take away the standard deviation, okay? So if we then look at two standard deviations, you can see that covers 94% of our data set, and price either moves up or down 4%. And then if we look at 3 standard deviations, so I suppose that's a very extreme volatile day, that's capturing 98% of all historical moves. You can see that price has never moved above or below 6%, right? So this is very useful information, because if you were going to day trade this stock, okay, trading on a daily basis, it would not make sense for you to place a 10% target price, for example. So let's say there's an earnings announcement. In the last 20 years, the stock has never moved more than 6%, so having a target price of 10% is just, you know, completely unrealistic. The probability of that happening is less than 2%. Okay, so this information essentially tells you how the stock has previously behaved. And if we go ahead and look at the average positive return on a daily basis, it's about 1.4, and the average negative return is, yeah, about 1.3. So that's occurred just a bit more than 51% of the time, and on down days 46-47% of the time. So when it comes to day trading, for those of you that have had experience day trading stocks, or even, you know, FX for that matter, or indices, this is what a lot of the analysis looks like. Okay, you will see very low volatility when you're looking at daily analysis across the historical returns, or even the historical volatility of any instrument. So when you're day trading, you know, if you're looking to kind of make 1.32% a day, okay, that happens 51% of the time, then the probability of you getting it right is about 50-50, yeah? And the average return is 1.5%. So if you consider that with transaction costs, then you can see long-term day trading, it's going to be very difficult to make money. I mean, the odds just aren't in your favour, whereas if you look at trading over a longer time horizon, what you're actually getting is more volatility in a stock. So if we look at a stock over a weekly basis, you see the average return goes from 1.3% up to kind of 3.3%. So there's a good bit more volatility there. And again, monthly, you're then looking at about 7% plus or minus, and then quarterly you're looking at kind of plus or minus 11%. So there's more volatility as your time horizon expands, which is why we trade over 1 to 3 months. Okay, and what we're doing is we're using this this volatility analysis to help us determine where we want to place our stop loss and where we want to place our target price. So over a 1 to 3 month time horizon, I will look to have a stop loss. If I was looking to trade this particular stock, then I look at the weekly analysis to determine my stop loss. If I wanted to take a long position, then my stop loss would be outside this minus 4%. Okay, so about minus 5%. Looking at the average negative return and lower standard deviation, that would be a sensible stop loss. And then if I look at the quarterly analysis for a target price, I'm going to look for something between 11% and 17%. So if I wanted a 3 to 1 risk reward ratio, okay, I'd be quite happy to place a 5% stop loss for my entry price, and my target price would comfortably sit in at 15%. Okay, the probability of that happening is quite high. You can see the odds here, like the frequency of that happening has been 70%. Looking at the historical data, 75% of all the historical returns. And the last thing I would look at is the average volatility. So this is looking at the average true range. Okay, so these returns that I've talked about are simply comparing the the open price against the close price, because you've got a much better chance of getting in at the opening and getting out at the close than you do calling the bottom and calling the top. Okay, but you need to consider how volatile a stock is, and so you do need to consider looking at the highs and lows of the day. So this is exactly what the average volatility analysis section here does. This looks at the average true range. So jumping back into our data set, what it's looking at is it's taking the high of the day and it's taking it away from the low of the day to see what the volatility has been. And you can see the average true range for this specific date is just shy of 2%. And what it's doing is it is giving you an average. So the average volatility on a daily basis is just shy of 2%. On a weekly basis, which is where I'm looking to place a stop loss, you can see it's 4%. So this 4%, I tied in with this 4%. I'd be quite happy with a 5% stop loss on this stock. And I know, looking at the probability of returns, that a 15% return isn't far-fetched. Okay, and this tool is exactly what you want to be looking at when doing your stock analysis for just before trade entry. Okay, you can get a really good understanding of the nature of the stock you're looking at, and this tool can be applied to stocks, to currency markets, to indices, to sector ETFs, to break down the performance and really get an understanding of how your market performs. So now that you know how to interpret using the tool, I'll show you how to actually use it, okay, so that you can always carry out this volatility analysis for every stock that you want to trade. So what we need to do is get our data, and we can obtain our data through Yahoo Finance. So just go ahead and jump onto Yahoo Finance, and I'm going to look at the S&P 500 just to highlight this point I was talking about before with regards to volatility. Okay, so find your instrument that you're wanting to trade, and then clicking on the historical data, what we'll do is we'll choose our time period, go max. You want to obtain as much data as you possibly can, okay? And we're going to look at the daily data. So this is what you want to download. and then you can see you've got all of your data points. Now you're going to need to download this into Excel, so you've got download data here. Once you've got your data, just tidy it up. Now, something to note, you need to have the latest date at the top, okay, when you are pasting this data into the volatility analysis sheet, because the average true range analysis, okay, so looking at the volatility on a daily, weekly, monthly, quarterly basis, this looks at just the last 2 years worth of data, okay, to keep it relevant, and it's going to look at the most recent data sets when doing that. Alright, so just remember that. You can see here that the S&P data starts at 1950, and what we want to do in order to kind of get the latest date up the top is we can create a filter. To do that, simply highlight the top row, or a couple keyboard shortcuts for you here, Control Shift across and then Control Shift L will create a list, and we're going to filter by date, newest to oldest, okay? And then a second point to note is that this data, in order to build out this spreadsheet for you, I've capped it at 8,008 rows, so that's about 30 years worth of data. Try and paste any more than that, it just won't go ahead and copy, okay? So what to do is, in order to quickly grab 8,008 data points, is just see how old your data goes. Now we've got 16,000, 17,000 rows here for this S&P 500 data, which is a bit much for us. So if we hit F5 and we'll go to A8008, okay, so we can go as far back as the 15th of August 85, and then Control Shift across, Control Shift up, and we'll just go down one row, Control C to copy our data, and then Control V to paste that data in. And we'll just give that spreadsheet a second to update. You can see it's calculating here. Once your spreadsheet is done updating, when you then jump into the analysis tab, you're going to have the relevant data. Now, just if you're going to save these, update them as you go. So we're now looking at the S&P 500. Okay, and you can see here that the average volatility for the S&P 500 is less than 1%. Okay, obviously that volatility increases the longer out our time horizon goes. But back to this bit on day trading I was talking about before, you can see here that on a typical trading day, the S&P 500 only moves either 1% up or 1% down, and that's most of the time, right? 79% of the time. So I'll reiterate this point that I made before, that as a trader, it's volatility that creates opportunity for you. Okay? For those of you that have got experience day trading and maybe haven't found success with it, this is probably the reason why, because you're trading markets that just don't have volatility within them. So I'd encourage you to run analysis on different markets. You know, look at the currency markets, look at sectors, look at specific stocks, and just see how they've performed in the past, because you need to understand the behaviour of whatever instrument you're trading, and this tool is going to allow you to do that. So that's a complete overview of the volatility analysis tool. Any questions on that, just jump into the TradingFM forum. You can now use this information to help you place appropriate stop losses and target prices.